Well, traders, they did it again. Institutions bought the dip and continued to buy in the latest CFTC Commitment of Traders report, which I'm going to show you in just a second. Meanwhile, retail traders got totally scared and sold into all of the fear and the scary headlines about Trump tariffs sending us into a recession. Just when everybody got spooked out of their shares, the market rebounded and had one of its greatest rally backs that we've seen in its history. Up 22+% in just a few short weeks is a absolutely phenomenal rally. Now, if you're sitting there, you're feeling pretty silly for selling or getting short or getting scared in this environment, you're not crazy for doing that. The market is a psychologically difficult place to make money because when this is occurring, everybody gets so scared because the news is pumping out some of the scariest stuff you could possibly see. And it's a recurring pattern in the stock market history. When the market goes down, a lot of times people fear the worst and they can't bring themselves to look at possible opportunities in the market. On this channel, I do my best to stay objective with economic data or the fundamental analysis, sentiment analysis, and technical analysis. And in this video, I'll be giving you my ideas for the week ahead. If you enjoy my content and find it helpful, make sure to subscribe, hit the thumbs up button, and let's jump right in. So first of all, I want to show you with the title and thumbnail what I mean by quote unquote, they bought. Well, this is it. The CFTC's weekly Commitment of Traders report shows us institutional money flows. Now, no, I know it sounds too good to be true, but no, it is actually straight up what it is. Now, it is a couple days delayed, and it's not a holy grail indicator, but it does tell us generally which instruments institutions are net long or net short based on the futures contracts reported. So what we can see here is we have the top section, which is our net positioning, which of course can show us overall, the long to short ratio in terms of positioning held by institutions. However, what I really want to draw your attention to is actually this secondary chart down here, which is our latest COT buys and sells, which shows the week-to-week changes in their positioning. This is far more important for those who are active traders, whether you're a swing trader or a day trader. I find this to be very useful. So what I want to show you when I say quote unquote they bought, here is what I'm talking about. Take a look at the Dow Jones, which in the latest filing, we saw a significant increase in long contracts and a decrease in short contracts. Take a look at the S&P 500, which had a significant increase in longs and a massive decrease in short positioning. Take a look at the NASDAQ, which had a significant increase in longs and a slight decrease in long contracts. And take a look at the Russell, maybe the least bullish of the accumulation, but still accumulation nonetheless. They added significantly more longs than they did shorts. So that is what I mean by quote unquote, they bought. Institutions are something that we can track through the Commitment of Traders data. And my team has specialized in building these tools to help traders to spot these opportunities. If you want to try out our software, there's a link in the description down below to try it for 30 days for $199. If that is something that you're interested in, use it down below in the description. And if you'd like to just pick up a copy, there is a promo code down there for you that will get you a nice discount on our products, YTVIP. Or just head over to our website if you want to explore the full list of features of this tool. Check it out, a1trading.com. Just head over to our website. Under Edge Finder, just do tutorials, and you can go through our entire free course material on everything that the Edge Finder has in store for you. You can see we have a full tour. You can watch videos on it. You can go through all the different tools like what we're looking at here, which is, of course, the institutional positioning. If you want to read about that, like I said, we build a large list of tools. And if you'd like to explore our resources and take your trading to the next level, check out the link and promo code to get a discount for subscribers in the description down below. So the S&P 500, where am I at with it? Well, it's not just institutions buying the dip that actually looks attractive to me. It's also a whole bunch of indicators that we pay close attention to. So I actually want to just take a quick pulse check at the U.S. economic heat map, which is showing a strong bias for U.S. stocks. Why is that? Well, it's because many of our indicators when looking at the indices are strong. GDP came in better than expected, PMIs came in better than expected, retail sales better than expected, and inflation is cooling in the United States down to 2.3 and 2.4% respectively when looking at the CPI and PPI. These are good indicators. The U.S. economy looks, in my opinion, to be relatively stable in all of this craziness, and so I continue to be bullish as I have been through this market sell-off. In fact, I'll show you that I currently have quite a few positions from the recent sell-off that are all almost, well, yeah, everything except for ExxonMobil, everything is in the green for my portfolio. Now, I'm not saying this to brag because there was also a period where I had a pretty good drawdown during all this craziness. So I was definitely early to the idea. I bought in over here, I bought in here, I bought in here. But since then, the stock positioning that I've done has really bounced back. By the way, I just launched a stock market channel specifically focused on stocks. I'll leave a link in the description if that's something you'd like to explore. I put out some stock ideas for this week yesterday. Now, when I look at the S&P 500 at an index level, however, which is what many of my audience members are looking at, or I take a look at the NASDAQ and we say, hey, how are things looking here? Well, price action looks really good. To me, it looks very path of least resistance like to go back up and test this all-time high. We've had some of the tariff stuff. The worst of it, I think, is behind us, the big fears that we saw. Now, could I be wrong about that? And could we go back and test the lows? Sure. But trading is all about probabilities. And I'm taking trades like, for example, the one that I took on the Russell in the last 2 weeks, which is basically, I took it not this past Friday, but the Friday before. I went long the Russell with a stop below. I'm now floating just under a 1-to-1 risk to reward. I'm looking for a move above this level of 2100 on the Russell to trail a stop into profit further. So I am watching this one, and I do think that this has some serious potential to bounce back alongside the other U.S. indices. When we take a look at the U.S. dollar for the week ahead, what's my bias on this one? Well, the U.S. is the stock market looks really attractive to me due to cooling inflation, but that cooling inflation really makes things mixed for the U.S. dollar, where we're getting a very, very in the middle reading for U.S. economic data. So that should reflect in most of our top setups algorithm ideas. So if I were to filter, for example, just to major currency pairs, you can see that I'm not really getting a very strong reading on the US dollar. I've got USD CHF, USD CAD, NZD USD, Euro USD. These are all getting neutral readings. And then I've got one that is bearish on the US dollar, this pound dollar bullish, and then one that's bullish on the US dollar, the Aussie dollar short. So there's a mixed sentiment here when I look at the kind of aggregate level. But if I was to trade USD pairs, this would probably be the one. In fact, I do already have a USD JPY long position. And if I pull up the US dollar here, let's talk about where we're at. Well, we're in the middle of no man's land. We've gone back and forth on this chart, and I really don't have a strong conviction one way or the other. I'd be looking specifically for a break above this level of resistance being 102 or a break below the level of support right around 98.5, which was our previous low and where we've kind of held out for the last few weeks. So when I look at the dollar index, I don't really have a strong bias. However, there is something that could give it to us coming this week, which is NFP on Friday. Now let's talk about the labor market right now really quick because it is important to the context of this upcoming NFP report. So if I go down, I'm going to scroll down to my, labor market data, and we take a look at the last two NFP reports really quick. What you'll see is that the last two, this red dot is your forecast for what analysts had expected, and the blue bar is what actually showed up. So what you can see here is that we had a better than expected one two NFPs ago. The previous NFP was better than expected as well. And so this has been holding up some security in the stock market because people were really afraid that, all of the tariff stuff was going to cause a whole bunch of layoffs, and we haven't really seen that materialize in the data. However, it's not perfect either. We saw this past week, our unemployment claims ticked up to 240,000. So there was a slight higher unemployment claims level for the weekly filed report. Unemployment rate, however, in the United States is still very low at just 4.2%. That is well below long-term historical averages. And we take a look at job openings. They have been deteriorating. However, as I've pointed out many times on my channel, if we expand our search to the last 5 years, we're simply normalizing to similar levels pre-pandemic. In fact, we're still slightly above that area, so I'm not too worried here. The labor market seems to be holding up okay. How about inflation? Well, inflation has been cooling off pretty nicely. We saw inflation cool very nicely, went sideways for a little bit, and now we seem to be on a path back towards that 2% target. However, what about the two T's, Trump's tariffs? Does this cause a problem to inflation? Well, the answer is nobody knows for sure because while there is very much a consensus that tariffs would cause some amount of price increases, especially on the consumer who pays them. That is not really heavily debated. Everyone kind of knows that. Where people do debate this more aggressively is whether or not Trump's tariffs, if they get, enacted into or long term, they're sticking around, and that's really our new paradigm shift. Does that cause prices to go up one time for everybody, and that doesn't really have a lasting impact? Or is it something where we see a persistent inflationary pressure? And while you may feel a certain way on this, very intelligent economists are split on this idea, and not perfectly split. Obviously, there's people who with different things, but the point is, smart people on both sides. Some people say, like for example, Jerome Powell, when pointing out around 2018, when we saw the last round of tariffs with Trump, they caused one-time hikes. But then other people say, well, we're already dealing with inflation currently relatively higher than where we were in 2018, so this could have more lasting impacts. That's why I say everybody is sort of confused about what to do about tariffs. So what's the consensus? Well, the Fed decides right now, it seems like they want to just hold rates steady and wait for more clarity on the tariff side. And I think that's why we have a lot of pauses in the market. When we pull up gold, you can also see we've been choppy back and forth because tariffs have kind of, they escalated very quickly and then they cooled off a little bit. And so now we're just sitting in no man's land. Price action wise for gold, it is very much in a long-term upward trend that I do think looks likely to continue. However, I don't see it continuing very aggressively in the short run unless you get something that seriously spooks the markets and sends us to a fresh high. What I mean by that is right now, we have mixed economic data for the US dollar. As I showed you in the economic heat map and what we just discussed, right? Inflation's cooling off, so hey, the Fed can cut rates. But labor statistics are coming in relatively strong, so I don't see a dramatic, drop off in recession fears, which would cause gold to spike. So this USD impact also kind of expands to gold, giving us a neutral reading in both camps. So for me right now, gold is very much a neutral rating. What is a strong rating? What are we actually looking for right now? Well, I'll tell you, the top setup simple page is blaringly obvious that the indices are kind of the crowd favorite, or not the crowd favorite, the edge finder favorite at this time. And that's been a phenomenal call this year. I've done at this point in my account. Oh, let me show you actually. Year to date, if I take a look at my Webull portfolio, which is my main public portfolio, if I just compare this to the S&P 500, you can see that the S&P 500 has done a 0.5% gain for 2025 so far, and my portfolio is up about 11.6%. Nothing crazy, but for me, this is very good in terms of a relative performance to the indices. And a lot of that has been buying the indices at the right time, right? So going into the market sell-off, I wasn't super heavy long indices or stocks, but I've picked up stuff since then, and that has ended up being one of my better calls this year. So let's continue to look at some of the other stuff here on this list. Here's your list of currency pairs that look interesting. Euro pound is one that I really like on the short side if I'm looking currency side, and I would love to get short on this one if I can get some overextended levels on this. So the way I trade currencies is a little bit differently than how I trade indices and commodities. I typically do trade a little bit more of a mean reversion or contrarian style on a longer term basis, price action wise to currencies. So I'd love to see this thing spike up into some overbought kind of extended areas. Over during these red dots, I traded the euro pound short, made some decent money there. So now I'd like to try and get a similar scenario setting up. So gonna watch euro pound to see how that shakes up. If we take a look at the Australian dollar NZD, I was short this one, took a profit on it inside of our VIP group. Wish I had held it a little bit longer. Now we're starting to get down to this overextended to the downside. So I'd be looking for a push back to the extremes here in order to potentially start a short position on this one. If I'm taking a look at the Australian against the US dollar, so Australian USD, so let's pull this up. Pretty much no man's land here, very choppy here recently alongside a lot of the US dollar pairs. What looks a little bit more interesting to me on this list right now is oil as well, included with the indices here. So let's just go US oil. I can pull this up here for a second. Actually, hold on. Let me just do my WTI here. So What we can see here is oil is also chopping around. I've been looking for this breakout for a minute now. If we can get some break to the upside, I am very interested in potentially a break above 64 and then looking to buy the dip if we can get some momentum started on oil. But I'm not really in a rush with this one as it's kind of been just dragging lower over the last few years. Trend is still downwards here. I'd love to see a break of that pattern before trying my hand at a small long position on oil. Another list item here for me is going to be Bitcoin. So Bitcoin is sitting near the all-time highs. As we speak here, it's not too far off from that 112, sitting at 104.5, at least here on Saturday evening as I record this video. I'm looking for something like a break to the new highs and then a pullback. However, where we currently sit, I actually don't hate the idea of potentially getting long with a small position on Bitcoin. You know, what is very peculiar about the way Bitcoin trades is that when it's moving, the pullbacks are very brief, right? So like if this thing is really going to pull back, if it's going to pull back and keep going, what I mean is usually that pullback is brief. It's not a very long, deep pullback before it kind of continues its motion. If it's going to do sort of a run to like 140 or 150 this year, let me just add some context on this. For Bitcoin to go to like 150 this year, what I think you need to see is the tariff clouds roll away and the Trump administration to start focusing way more on, deregulation within the business world, keeping taxes low, things like that. Some of the things that people in Wall Street really were excited by with the Trump administration. The tariff stuff has spooked everybody, but Bitcoin on a relative basis has done phenomenally well. Another kind of thing that has done phenomenally well in all of this, despite all of the craziness, has been the German DAX, which is an absolute beast of an index this year, doing much better than the U.S. indices even, and has been a nice bullish reading here. Where's our DAX? DAX is still bullish. You can see right here. DAX getting a bullish rating on the Edge Finder. So I'm looking for pullbacks. I've been kind of a broken record on that this year. When this occurred, I was live streaming and I did pick up the Russell instead. But I would like to also, so when we saw that dip that day, I bought the Russell on that same kind of few hours shortly after. I'd like to get into the DAX. So if we do see a pullback down to this area, I do think that this trend continues. The winner, I think, continues to win this year, most likely. Given the circumstance, I really like the DAX for some upside on that front, and we'll continue to watch it going forward. Let's also take a look at some of the British pound currency pairs. So if I just pull up just quickly the Eco Surprise Meter, this is one of my favorite indicators within the Edge Finder at this time. What it does is it shows economies that are surprising economic forecasts across their metrics pretty strongly, or weekly. Right, weak. I don't know the right terminology there. Point is, if we take a look at some of our high scoring ones like the British pound, now the Japanese yen, very interesting, the Kiwi dollar and the Australian dollar, right? When we look at that list of things, in fact, I need to look at this JPY because we had a shift there. When we look at these are currencies that are looking a little bit more strong, if you will. So what that means is that their economies are outperforming expectations recently. Let me show you a quick example with an easy one, which is the UK economic heat map. What we can see here is that when we look at things like inflation, which came in higher than expected, that's bullish for the currency. We take a look at, for example, retail sales, services PMIs, GDP growth. These things are beating expectations as according to the analyst community. And so that is showing us these currencies should be a little bit stronger. So that's what I use very heavily when I'm trading Forex, as I'm looking at the economic data for the respective region, and I automate that process with software. I mentioned this earlier, but if you want a copy of the Edge Finder, there's a link in the description down below to where you can get some information about how it functions, as well as how you can pick up a copy for a discount. So when I look at like pound pairs, right? So if I pull up GBP USD just for starters, we can see the pound dollar looks really good. It looks really, really strong. And it is a top contender for me in terms of potential FX setups going into this week. So if I pull up pound dollar, it is a +5 score. I'd like to see that thing a little bit stronger. I just want to take a quick look at the institutional money on this one, see how things are looking. British pound is very mixed, 60-40, and the US dollar is 50-50 or so. So not a huge bias on either of those currencies from an institutional perspective. But in terms of the economic data, like I said, the UK economic heat map looks pretty attractive to me in terms of relative performance. And when we pull up our overall eco surprise meter, we can see here British pound getting a really strong reading, dollar index kind of on the weaker side. You can see that really the weakest of the group is actually the euro. So I showed you that euro pound idea. That is probably a top contender for me on this list, purely based on, and I guess Euro NZD, if I was going based off just the eco surprise meter, Euro NZD, which is also a top setup at this time on the short side. So if I were to get, some kind of overextension to the upside on this pair, which by the way, this is a very volatile pair. So I'd have to take a very tiny position with this one. And actually I'd probably trade 0.01 lots on this one, 0.01, and just look to scale into a couple positions on this one. But I'm telling you, the Euro Kiwi is a very aggressive currency pair. That's 1,000 pips right there. So when I say 0.01, yeah, that sounds tiny, but remember which currency pairs you're looking at. Because, for example, let's go look at the euro pound, and I'll show you, here's a big move, right? That's 400 pips. That's very different than 1,200 pips or whatever with the euro Kiwi. So, different currency pairs move more or less aggressively. And if you're an FX trader, your lot size should consider the volatility of what you're trading to some degree. So I do like these quite a bit. I'm watching the British pound against several currencies. And if I go back to my top setups page, specifically the Australian dollar, I'm not really interested in getting too long the dollar at this time either, just because it's getting a mixed reading. However, the commitment of traders data is seriously showing some favoritism there on the US dollar compared to the Australian dollar. We could just pull that up just to see what that is referencing. Oh yeah, here. So you can see 79% of positioning is short the Australian dollar on the institutional level. Very interesting. Let's take a look at some market sentiment here too, because this is just going to be a good crowd sentiment source. The AAII Investor Sentiment Survey still shows a heavy preference towards risk off for kind of retail investors, suggesting that they still feel more bearish than they do bullish on the U.S. stock market. That is impactful to not just stock indices, but to all markets. Take a look at the put-to-call ratio. We do still see an elevated put-to-call ratio, suggesting people are still wanting to buy puts for insurance. They're still nervous about the market to an extent. Bitcoin to gold ratio, however, does show something interesting as well. Take a look at this. So our risk on indicator, which is Bitcoin outperforming gold, has since sort of shifted back into a little bit of the moving average here, which I believe this is just a 20 moving average applied to this ratio. And so we are seeing that a little bit shifted back the other way, as maybe gold got a little bit of a bid in relation to Bitcoin in the previous week. So there's a little bit of that. If we take a look at consumer sentiment, consumer confidence, had an interesting read last week that I think I need to share with you guys. For the first time in a while, we beat forecasts by a nice margin, showing consumer sentiment bouncing back a little bit. Consumer confidence is a very important indicator, and we've recently added it under the market sentiment tab for our Edgefinder users. Explore it there and keep an eye on it at your convenience. So definitely something that I'm watching is keeping an eye on these consumer confidence reports, which, like I said, have been in the dumpster for a few weeks. And for the first time, we actually got a little bit of confidence from the consumer, perhaps suggesting that we're moving past a lot of these worst case scenario tariff concerns. Are tariffs going to change things? Sure. Could they cause some economic slowdown? Sure. But I think what the market is celebrating is you're not getting the worst case scenarios of, Donald Trump at least, and China kind of going head to head and just putting 100,000%, whatever, an arbitrary number of percentage on each other in terms of tariffs or duties on imported and exported goods. Seems like we've significantly de-risked that situation. Doesn't mean there's not still risk, but the market's saying, okay, we're not going into World War III with all this, at least right now, right? We're looking a little bit more like we could see some deals in the coming weeks. Also, I was just playing around with this on the dev side. We did get consumer confidence for other places as well. So for example, if I want to pull up the UK, or if I want to pull up Japan or New Zealand, you can pull up these data points and see the consumer confidence reports for these other places too. Thought that was really cool, especially for our FX traders here in the audience. Play around with that if you have a copy of the Edgefinder. Also, just a heads up, if you made it to the very end of the video, we are looking for more people to join our VIP VIP group and come trade alongside us. Get access to all the trades notified by my team as well as myself. If that's something interesting to you, stay tuned. We're going to be dropping some sale announcements on Monday. It's going to be our biggest sale of the year for VIP memberships. If you'd like to explore that preemptively and see if it's right for you, head over to our website, a1trading.com. Under signals, just click get signals and you can explore all of the different features that we offer here. You can see we share a whole bunch of trades. We do coaching webinars. We offer our strategies and guides. We have a trade tracker where you can see trades that I'm currently in. We share track records to show you that is, like I said, a legitimate operation, that we actually do what we say. Here's some examples of the service. And then we have Alan Perez joining us on Monday, which I'm very, very excited. He will be sharing his FX specifically trades. We have Ivan, myself, Alan, Chris Pulver also available to see everything that they are doing, as well as myself in the markets. So our signals and our coaching and our chat rooms are all available, and that big sale is going to be starting Monday. So stay tuned on that. Okay, guys, thanks very much for watching. Have a safe trading week ahead. We'll see you next time.